Hello everyone, this will be the last video that I'm going to be putting together for this week. So more theory videos will follow next week. Now in this video, what I want to do is to go over the concept of long run aggregate supply. Now this can be quite challenging, so I want to spend a bit of time building up what a long run aggregate supply curve is. Now before we get there, I want to go back to a diagram that we've done a lot of across the last year or so. A production possibility frontier. So let's imagine we've got an economy that can produce goods and or services, or consumer and capital goods, whatever you want it to be. Now as a reminder, the PPF, it measures the maximum number of goods and services that an economy is able to produce with its existing factors of production. Now what we know is that economies often don't achieve the production possibility frontier, especially in the short run. So an economy could originally be operating at G1S1. Okay, so that would mean that the economy has at the present got what we call spare capacity. That is the gap between the output, so the GDP of the country, and the country's PPF curve. Now, what we could do, we could think about graphing this using ADAS diagrams. Now, if we start off at G1S1, the value of all those G1s and S1s produced would give us the size of our economy. Now, if GDP was to increase to G2, S2, then it means that we're experiencing actual economic growth. Now, on an ADAS diagram, this will be shown in one of two different ways. So it could be caused by an outward shift in aggregate demand. So if AD moves outwards, firms have got to produce more output, so the quantity of goods and services and the value of them would increase across the economy. We could also show it by an outward shift in short-run aggregate supply. So both of these diagrams would show the economy moving closer towards the production possibility frontier. So it's the causes of going from G1S1 out to G2S2. Now, of course, if an economy experienced a recession, it would mean that the output would fall across the economy. And we'd have an even bigger spare capacity in the economy. Now, to move from G1S2 to G3S3, it would be caused by either aggregate demand falling, or it would be caused by SRAS moving inwards. So what you've got there, everyone, are the causes of actual economic growth. Now, a long-run aggregate supply is looking at something a little bit different. We're not looking at the actual, we're looking at the potential of the economy. So what we're going to do, we're going to think about two very different long-run aggregate supply curves. So we'll stick the axes on this one. We've got price level and we've got real GDP. And what you could be thinking about when you watch this, which one do you think sounds like the most plausible explanation of what could happen in an economy? Now we're going to be thinking about something called a classical, which is a free market view of a long-run aggregate supply curve. And then we're going to be looking at a Keynesian long-run aggregate supply curve. Now the big difference between the two is a classical Keynesian LRAS curve is a free market view. So classical is free market, Keynesian is more of an interventionist LRAS curve. Right, now what we're going to think about then is what actually is a long-run aggregate supply curve. Let's draw them first of all. So classical, we have, that's a vertical line, or it's meant to be. So we've got a classical long-run aggregate supply curve, and then we've got something we call a Keynesian long-run aggregate supply curve. Right, okay, now let's start off with the classical LRAS curve. Now, first of all, I want you to think about the long-run aggregate supply curve as the potential of the economy. This is a way of thinking about the country's production possibility frontier. Now, in a classical world, we draw the LRAS as a vertical line. Because what a classical economist would assume is that in the long run, all factors of production will always be used. So let's give you a scenario then. Let's imagine we start off, so we delete one thing. How do I do that? Bear with me on this one. Right, let's get back to the pen. So let's imagine an economy is starting here. Now look at the problem in the economy here. The potential of the economy is YFO. Now YFO stands for the income of the country if we were at full output. So all that means is if every single factor of production was employed in the economy, we would be operating at YFO. It's the output we can produce with an efficient use of all of our factors of production. Now in this diagram, the economy is only at Y1. Y1 to YFO is measuring the spare capacity in the economy. So we've got unemployed workers across the economy. Now you've got to think about how a free market would tackle this problem. At Y1, we have got unused factors of production. Now that means that we've got excess supply. There's more resources being supplied than what businesses want to demand. Now when you think about a free market situation, think about simple supply and demand. We've got demand and we've got supply. When you've got an excess supply, it occurs above the equilibrium point. So that means that the given price level, the supply is bigger than the demand. Now all a free market will do is to use the invisible hand to bring down price levels across the economy. And as price levels fall, we get to the point where supply meets demand. Now in a classical world, this is what will happen here. If we've got YFO resources being supplied, but only Y1 being demanded, then we've got an excess supply problem. So unemployed workers now will think, you know what? No one's demanding me at my current wage rate. So in order to get jobs, workers will have to automatically lower their wage expectations. So unused resources will lower their prices. Now, when you think about it, workers are a cost for a business. Their wage is a cost for a business. So if workers are suddenly prepared to work for lower wage rates, then it would lower business costs. And short-run aggregate supply will move outwards. And what this will mean is that in the long run, we're going to get to this magic point here where we operate at YFO. So a classical economist would assume that in the long run, markets will clear. The invisible hand will ensure that we always operate at the YFO. Now, a Keynesian economist will say that's nonsense. Now, in a Keynesian world, we don't worry about short-run aggregate supply. We add on AD. So we start off with our aggregate demand curve. Now, again, a bit like in the classical world, at this equilibrium point here, in the short run, the economy is operating below its potential. So we could be at YFO, but we're only at Y1. Now, whereas in a classical world, markets would always clear to ensure in the long run we always operate at YFO. In a Keynesian world, this can't always happen. And that is because John Maynard Keynes spoke about sticky prices. Now, what we mean by sticky prices, there are imperfections in markets. There are interventions that are in place that will stop markets from clearing. So a good example could be if workers can't find work in a classical world, they lower their wage expectations and eventually somebody will give them a job. A Keynesian economist will say, well, actually, that can't always happen. If workers are already working at minimum wage, there is nowhere else they can go. They can't lower their wage expectations any lower. But also, we have trade unions in place, and these will also prevent wage reductions across society. So in a Keynesian world, in the long run, any output is possible. We could be on the YFO, but it's very unlikely that we will be. So in a Keynesian world, the economy can get stuck below its potential. Now, what a Keynesian economist would therefore say is we cannot wait for markets to clear. Keynes once famously said, in the long run, we are all dead. So we cannot wait for markets to clear in the long run. So what Keynes would say is the economy is like a stalled car at Y1. We could be at YFO, but we're not there because of sticky prices. Sticky prices or wage rates stop the economy from getting to YFO. So Keynes would say that governments need to intervene in the economy to get us as close to YFO as possible. So what they'd be required to do is to boost aggregate demand across the economy. And look at that. As AD moves outwards, the economy has moved onto the YFO. So what a Keynesian economist would recommend is that we use policies that we call demand management. Demand management policies is where we get governments to deliberately increase government spending or to lower taxes to try and get people to spend more across the economy. But also, if you were to lower interest rates, you're encouraging more borrowing, which would also raise aggregate demand across the economy. So overall, everyone, think about a classical economist as one that would leave the free market to fix spare capacity in the economy. A Keynesian economist would advocate intervention to tackle things like sticky prices in markets.